Good afternoon and welcome to the last Real Talk Economics session of 2024. My name is Markus and I'm the Chief Economic Advisor at Baker Ring. We are a global accounts receivables management company. And as the year is drawing to close, I thought this is a good moment to have a look at the developments that shaped 2024. Unfortunately, the year isn't finishing on a high. A lot of data series that I've been analyzing recently, they have deteriorated over the past few weeks and months. That is at odds with what we've seen during the summer month. The year looked a bit better mid-year. That has changed, momentum has been lost, and that doesn't bode well going into 2025. In terms of running order, I want to start with macroeconomic trends. It will be the usual mix of microeconomic conditions. We look at business confidence, for example. We look at consumer confidence. There will be a few data series that are holding up well, actually. Inflation is one of them. The labor market still looks okay-ish. And we will obviously also have a look at real GDP growth forecasts for 2025. Second chapter of today's presentation will be geopolitical developments. I'm convinced that you cannot talk about the economy without looking at economic trends as well as political trends. And unfortunately, recent weeks were rather eventful. Donald Trump will be back, and we will have a look at what the impact of that on the UK economy will be. Last chapter of the day will be credit risk. We will look at interest rates. I'll talk you through the most recent business-to-business payments performance data in Europe, and I will also explain the most recent insolvency stats. The deck should take around 40 to 45 minutes to get through, which means we have a bit of time for Q&A. If you have questions, please use the comments function here on LinkedIn, and I will address them towards the end of today's presentation. A few people have already submitted their questions beforehand. So without any further ado, let's have a look at macroeconomics. And as said, momentum has been lost in the last few weeks and months of 2024. So 2025 will be another year of low growth. We start with business confidence here, and we start with the US. And there are a few common trends across all geographies, but in the US, it is the most pronounced. And I will talk you through what I mean with that statement in a second. Here on that visual, on that chart on the right-hand side, you can see several lines. We're looking at PMI data, Purchasing Managers Index data for the US. Normally, they range between 40 and 60. 50 is a neutral line. In theory, they could be between 0, which is the worst reading, and 100, which is the best reading. But normally, unless there is a war, unless there's a pandemic, the range is between 40 and 60. Readings above 50 are good. Readings below 50 are bad. And in the US, the composite output index, composite meaning a combination of services and the manufacturing sector. That composite output index stands at 56.6 points in December, which is a very strong reading. In fact, it is the best reading in 33 months. However, and this is a common theme that you will soon realize in Asia and in Europe as well, there's a gap between services and manufacturing. Services tend to be more optimistic than manufacturing sector companies. In fact, in the US, the gap is the biggest gap ever recorded. Service sector PMI in the US, more than 58 points. Manufacturing PMI, 46 points, which is actually the lowest reading in 55 months. And we have to keep in mind that this survey was conducted after Donald Trump had won the election. So not even the victory of Donald Trump has lifted manufacturing sector PMI in the US. When we look at output expectations, we see that as a composite, so again, the combination of services and manufacturing, the reading is on the best level in 2.5 years, which is rather encouraging. However, again, this is only driven by services. New order inflow, for example, in the service sector is on the best reading since March 2022. In the manufacturing sector, it has been falling again. In fact, it has now been falling for 6 months in a row. Let's have a look at Asia. Slightly different visual here. We're looking at 3 sub-indices of the PMI. The blue bar represents the output sub-index, the orange one, the new order inflow sub-index, and the purple one represents the employment sub-index. In Asia, 18 sectors are included in that analysis, and 15 out of 18 sectors covered reported output growth in November, which is actually the best reading in 3 months. When we look at employment, slightly different story here. Only 9 out of 18 sectors, only 50% of all sectors covered reported growing employment. When we approach it from a geographical perspective, when we're looking at the manufacturing PMI, we see that the best performing country in Asia is Mongolia, 63 points. Admittedly, Mongolia isn't necessarily an important economy, not even by Asian standards, but then Saudi Arabia and India, 59 points and 57 points respectively, they are also doing rather well. China, bit of a different story, not as optimistic, I'd say. Manufacturing sector PMI in China is on 51.5 points, and that is up from October. In October, it was pretty much on the neutral line, 50.3 points in October. And to be honest, I would have expected a deterioration following the Trump election. I thought Chinese manufacturing companies would become more pessimistic now that Donald Trump will return to the White House, but the opposite happened. Manufacturing companies in China became a bit more optimistic, and now the reading is on 51.5 points, which is also the reading in the Chinese service sector. But in fact, service sector PMI in China has been falling last month. So again, in Asia, the situation is still overwhelmingly positive, I'd say, but there are some downside risks, of course. And talking about downside risks, let's have a look at the European readings. Same breakdown here: output, new order inflow, and employment sub-indices represented by the different colors. And in Europe, the situation is much worse. In Europe, we have 20 sectors being covered by that publication by S&P Global. And out of the 20 sectors that are covered, only 8 reported growing output in November. When you look at the sectors, you can see that automotive is the worst performer. That's not a surprise. If you followed the news, Volkswagen, for example, is in deep trouble. In the UK, Vauxhall is closing a factory. So this is a very pan-European trend that automotive is struggling. And again, similar to the US, there is a split between the service sector as well as manufacturing. The problem in Europe is that not even the service sector is in growth territory. The service sector PMI in Europe stands at 49.5 points, so below the 50 points growth threshold, and manufacturing stands even lower at 45 points, and that is down from an already low 46 points in October. And the 3 biggest economies in Europe, France, Italy, Germany, they are actually ranked bottom of the table here. So again, there's a split between manufacturing and services, but unfortunately in Europe, both sectors are in contraction territory. When we look at the UK, another visual here again, and we're comparing the UK reading against the Eurozone reading. The UK is represented by the blue bar, and the Eurozone reading is the orange bar. And you can see the UK is outperforming the Eurozone across all 3 sectoral PMIs. In services, in manufacturing, in construction, the UK reading is above the Eurozone reading. However, the UK has not been immune to that slowdown in manufacturing. UK manufacturing stands at 48 points, which is below the 50 points line for the 2nd month in a row now. So UK manufacturing contracting. New order inflow has been softening, which doesn't bode well for the future. It indicates pipeline problems. If you don't get the orders in now, you have nothing to produce in 2025. You have nothing to sell in 2025. So that doesn't bode well. Output has fallen as well, and employment has also fallen. Again, these are sentiment. This is sentiment data. It isn't necessarily in line with what ONS data says about employment. It's literally a survey that is sent out to purchasing managers, and they are asked, how do you feel about employment? How do you feel about new order inflow? But it gives you a good indication of where the journey is heading towards. In the service sector, the PMI is a bit more encouraging, but not by much. At least it's in growth territory, 50.8 points, so just above 50. But the current reading from November is actually the lowest reading in more than a year. In October, it was still on 52 points. Unlike in the manufacturing sector, new order inflow in the service sector is still growing, but it's growing by a very, very weak pace. And employment has also fallen in November for the second time this year. This is a fairly new development. Until October, employment in the service sector, at least PMI data indicates that, has been growing. The only outlier here is construction. Don't ask me why UK construction sector purchasing managers are so optimistic. In fact, November has seen another increase in that. So unlike in services, unlike in manufacturing, where things have been deteriorating, the UK construction sector is looking in a much better shape than its continental European cousins. And actually, we've seen an improvement over the past few months as well. So that was the business consumer side of things. When we look at consumer confidence, we're seeing a bit of a, well, on the one hand, it's a similar development. On the other hand, it's slightly different. Positively, obviously, consumer confidence has recovered over the past 2 years. Here in that chart, you can see the OECD Consumer Confidence Index. So that is an aggregate of several national consumer confidence indicators. So this gives you the global picture, effectively. And in 2022, many national consumer confidence indicators, including in the Eurozone, including in the UK, had hit all-time lows. Not even during Brexit or COVID or global financial crisis had consumers been so pessimistic than in 2022. Obviously, that was the height of that cost of living crisis. And since then, inflation has come down a bit, not a bit, quite significantly actually. Interest rates, they have come down a bit, and wage growth has been fairly robust. So consumers are less pessimistic. In some cases, are actually optimistic about the 12 months ahead. But unfortunately, over the past quarter or so, this improvement has come to a halt. In fact, in the UK, if we look at UK consumer confidence, that has taken a severe hit in September, another small hit in October, and then November and December have actually seen improvements. But in a nutshell, all the improvements that we've seen in the first 9 months of 2024, they were wiped out in September. So UK consumer confidence at the end of 2024 is pretty much on the same level as it was during January or February. So if you're selling to UK consumers, don't expect a massive increase in demand over the next few months or so. I mentioned that some time series have actually developed rather favorably throughout 2024, and inflation is one of them. Unfortunately, it's one of these exceptions. I said the majority of economic trends is a bit concerning, but inflation isn't one of them. Inflationary pressures have subsided across the globe. You can see that here by looking at the chart. This shows inflation rates in advanced economies and emerging markets. As you can see, in emerging markets, inflation tends to be higher than in advanced economies, but they're moving in sync. And according to the IMF's latest World Economic Outlook from October, price stability will be restored in 2025. Why has inflation come down? Many transmission channels here. First of all, commodity prices have fallen. There were base effects at play. Growth was fairly meager, and when real GDP growth is weak, then inflation tends to be weak as well. And then, of course, central banks had reacted to that massive spike in inflation. In many countries, inflation in 2022 was on the highest reading in 40 years, including in the UK, had hit double digits in the UK. And central banks reacted by raising interest rates. So that was the medicine that was prescribed. It was painful, but it worked. And now, as a consequence of these transmission channels, inflation is back or almost back on target. In many developed economies, target is 2%. And the most recent data points for the Eurozone, the UK, and the US indicate that we are a bit above 2%, but not far away. In fact, the Eurozone, the UK as well, they have seen a recent increase in inflation, but that was always priced in. It's nothing too concerning, and most forecasters believe that inflation will not become a problem going forward. In the US, might be a bit different. If Donald Trump really implements tariffs on a sizable scale, that could increase US inflation, but in Europe, growth is rather weak, so I'd expect inflation to be near the 2% target in 2025. Let's have a look at labor market data and have a look at unemployment statistics here. And I'm not sure if you remember it, but when COVID started, a lot of people were afraid that unemployment would rise significantly, and it didn't really happen. There's one outlier here in that chart, and that is the US, but that is simply a statistical issue. In the US, people that were on furlough, they were counted as unemployed. In other economies, Germany, France, the UK, people that were on furlough weren't counted as unemployed. That's why their unemployment rates, their domestic unemployment rates, did not move. So in fact, COVID did not lead to mass unemployment. And in fact, unemployment has remained on a downward trend over the past few years. In the Eurozone, unemployment has now fallen to the lowest level ever recorded. Doesn't mean a lot because the time series isn't that old. I think it has been around since the year 2000, but nonetheless, unemployment in the Eurozone, 6.3% in October, was the lowest reading in 24 years. Outside the Eurozone, mainly in Central European economies, Poland, Hungary, Czech Republic, full employment has actually been reached. Full employment is defined as an unemployment rate of around 3%. And there are countries like Czech Republic where unemployment stands at around 2.5%. So labor markets are booming, or in other words, unemployment isn't very high. In the UK, unemployment has gone up a bit recently, but it's still very, very low. It stands at around 4.3%. Does it mean there aren't any problems in the labor market? Well, yes and no. On the one hand, unemployment is low, but there are certainly signs of a labor market slowdown. And we can see that by looking at other time series analyzing the labor market. One of them is job vacancies, for example. Here you can see the job vacancy rate for the EU and the Eurozone. There's not much difference here, of course. And I could have shown you the UK development. It would have told exactly the same story. The number of job vacancies peaked around 2 years ago, all-time highs. And since then, the number of vacancies has been dropping, indicating a gradual slowdown. In fact, in the UK, the number of job vacancies has now been falling for, I think, 28 months in a row now. It's pretty much back to where it was before the pandemic. So companies aren't looking for workers as much as they were 2 years ago or even a year ago. But they haven't fired anyone yet. The unemployment rate hasn't moved yet, but the number of job vacancies has fallen. We can also see that gradual labor market slowdown when we analyze wage growth data. And again, I've picked EU data here. If I had picked or selected UK data here, very similar development, very similar story. We've seen wage growth moderating over the past few quarters. It has come down to a certain degree. That was driven by inflation coming down, of course, but it is also related to the fact that the number of vacancies has dropped. In the UK, we've seen an increase now again. That is a monthly data point. I wouldn't be too concerned about that. Ultimately, I think wage growth will certainly moderate in 2025 compared with the 2023 and 2024 readings. On this chart, we can see more structural issues. Here on the left-hand side, we can see the huge disparities in terms of labor costs in the EU. There are countries where labor costs, and labor costs isn't only wages, that also includes national security insurance contributions. And there are some geographies, some countries where they're still in the single digits, and then there are countries where hourly labor costs are above 50 euros per hour. So that shows the huge inequalities within the EU, which in turn is fueling problems of internal migration. And on the right-hand side, because obviously the UK isn't included in the EU anymore, you can see the disparities within the UK. And I found the bottom right chart very interesting. It shows you the developments of the median wage. Median you can treat as an average, statistically not correct, but let's treat it as an average. And you can see the purchasing power adjusted median wage over the past years or so, or more than a decade actually. And you can see that there are regions in the UK where that median salary has fallen quite significantly, and maybe that explains the success of non-mainstream parties as well. If you're not seeing pay rises, in fact, if you're seeing pay decreases in real terms, you might be more encouraged or more willing to vote for Brexit or to vote for a party that is at the fringes of the political spectrum. So let's have a look at the most important indicator there is for us economists, and that is real GDP growth. If we want to assess the well-being of an economy, this is our go-to figure. And here on the right-hand side, you can see the latest projections from the IMF. There are a few months old now, they're from October. And you can see that the IMF expects the global economy to grow by 3.2% next year. That is fairly unchanged from the 2024 estimate and the confirmed 2023 figure. The differential between advanced economies and emerging markets is fairly small. Normally that's much bigger. And we also have to keep in mind that 3.2% growth on a global scale is actually a fairly disappointing figure. Global growth used to be much higher a decade ago or 20 years ago. And problematically, the risks are clearly tilted towards the downside. These projections are from October. Obviously, Donald Trump hadn't been elected in October yet. So in April, the next World Economic Outlook will be published. And I expect that there will be some downward revisions. In fact, other professional forecasters, such as Goldman Sachs, they have started to reduce growth forecasts for countries that are highly exposed to the US. For example, the German economy has seen a massive downgrade in Goldman Sachs forecasts since Trump has been elected. When we look at real GDP growth from a national level, we realize that US growth this year, reaching around 3% probably, will be more than 3 times the Eurozone reading. So there's a massive gap between Europe being the Eurozone here, and the US. That is mainly driven by the ongoing weakness in Germany. Germany is likely to see another real GDP contraction this year, following the contraction in 2023. And while the IMF expects German GDP to grow next year, I'm more pessimistic. I think it's a realistic scenario to assume that German real GDP growth will also contract next year, which would make it a 3-year contraction, which Germany has never seen in peacetime history. China is another story where headwinds have certainly increased recently. Chinese growth has been slowing down. Country is at risk of falling into deflation. The government will react by fiscal policy measures, implementing them. But China is certainly not that global growth engine it used to be. India, however, is becoming the new poster boy, reporting good growth. But that doesn't mean that India will rescue the global economy. It's just too small to shift that global leverage. entering the Indian market is rather complicated. Government interference is high. So just because India is growing robustly doesn't mean that exports to India will pick up on a noteworthy scale. The UK is forecast to grow by 1.5% next year, as well as in 2026. Again, these forecasts are from pre-Trump days, effectively. Goldman Sachs, for example, has reduced the UK growth forecast by 0.3 percentage points, but by European standards, 1.5% growth is actually not too bad. There are other markets that are forecasted to contract. Let's have a look at geopolitics, an ever uncertain world. I've titled this part of my presentation. There is high uncertainty, maybe not so much in the UK. Risk levels are fairly low from a domestic point of view, but unfortunately in the US and in the EU, risk levels are very, very high. 2024 was a very important year for global politics. By the end of it, half of the global population will have elected a new president or a new parliament. That was mainly driven by India. India is now the biggest country on the globe in terms of population, but there were also elections in South Africa, in Mexico, in the UK, of course, in France, in Ireland, European elections, Russian elections. So 2024 has seen a lot of elections, and it has also seen a medium-term or long-term trend actually continuing. And that trend was that anti-establishment parties are doing well. 15 years ago, during the global financial crisis, these anti-establishment parties were very often from the left of the political spectrum. Now they're from the far right of the political spectrum. And the election success of these far right parties, that has led to fragmented parliaments, which in turn has complicated coalition building. So you just need to look at countries like Sweden or the Netherlands that used to be governed by one party or two parties. Now there are 5-party coalitions in office, and that is obviously rather problematic because it will take time to reach a compromise. If you have to find a compromise between 4 partners, the likelihood that everyone will be disappointed is fairly high. That political fragmentation is visible even in G7 economies that used to be very stable. So, for example, in Germany, early elections. France has seen early elections this year. Canada and Spain, quite weak. In Spain, at least the government has a majority. In Canada, it's a minority government. And then in other economies like Italy, Sweden, and the Netherlands, the far right are either running the show or are a junior coalition partner. And although as an economist, I'm obviously agnostic to who's in power. For me, it doesn't matter if it's a far right, a far left, or a moderate politician. But for me, it matters what their economic policies are. And quite often, the measures that these governments have implemented, they are at odds with global free trade or growth-friendly policies. So all of that is creating huge concerns. And if you don't believe me, you can look at the chart here. This is the Global Economic Policy Uncertainty Index. The higher it is, the riskier it is, effectively. And as you can see, there's a clear trend. Economic policy uncertainty has risen quite significantly. This is nothing that started with Donald Trump or with the Ukraine war. This is an ongoing trend that we've seen for several decades now. In Europe, the uncertainty has increased even more because the European growth model that has been in place basically since World War II is under increasing threat. And it's under threat from several angles. On the external security front, NATO might soon be history if Donald Trump really implements his campaign threats. NATO will no longer provide security for Western Europe. Whether it will be that bad, we will see, but it is certainly a scenario which would be quite concerning given how weak the military is in Western Europe. From an economic point of view, free trade is endangered, and free trade has always been important for Western Europe, especially for countries like the Netherlands and especially Germany. New tariffs could be implemented. Subsidies are an increasing problem. That is something that the Biden administration has also implemented. So this is nothing Trump related, but obviously with Trump returning, this risk has certainly gone up over the past 6 weeks or so. There could be a looming global trade war. If the US really implements tariffs on a sizable scale, this will have global ramifications. Another trend that will continue is nearshoring, also called friendshoring. Nearshoring effectively started during COVID. So this was driven by supply chain stress. If you remember, in 2020 and 2021, it was very difficult to get goods out of China because of these severe lockdowns. So companies started to look for options closer to home geographically. And although the COVID restrictions have long gone, now it's more of a political development. Companies, especially large companies, are encouraged by their domestic governments to source input goods from closer to home geographically, but also ideologically. So rather than getting everything out of China or out of Russia or out of regimes that are fairly unstable, companies are encouraged to source from Turkey, Romania, Mexico. In the case of the US, the Biden administration was very successful in getting new factories built in the Rust Belt states. It didn't deliver an election victory for the Democrats, but again, this shows that bringing factories from China to the US isn't Trump specific. This is something that the Democrats had also done. One scary figure here in that respect are obviously the growing tensions between China and the US. Now with Trump back in office, I wouldn't say a war is imminent. In fact, I think it's unlikely, but nonetheless, the colleagues from Bloomberg Economics, they have estimated the costs of an armed conflict between China on one side and the US on the other side. And of course, there will be other countries involved like South Korea and Japan and Russia. And well, in that scenario, it's not escalating into a world war. It's not escalating into nuclear war. But even in that scenario, which is a very small military conflict, global GDP would shrink by 10%. A war between the US and China would shave off 10% of global GDP. And to put that in perspective, COVID cost around 6% of global GDP. The global financial crisis also cost 6% of global GDP. So again, this is not the baseline scenario, but risks have certainly risen over the past few years. And with Donald Trump back in the White House, tensions between these two countries, they are likely to increase. Let's have a look at the UK's exposure to the US. And obviously, the transmission channel everyone talks about is international trade. And in fact, the US is a very important trading partner for the UK. In fact, the US is the UK's most important trading partner. That is a bit at odds with what you've heard during the Brexit years, because back then everyone said the EU is the most important trading partner, and that is correct. If you look at the EU as an aggregate of 27 member states, the UK exports more to the EU and imports more from the EU than from the US. But if you look at it on a country level basis, the US is the most important market. In 2023, the US took 22% of all UK exports. Second ranked country was Germany. Germany only took 7%. So the US took 3 times as much as Germany took in terms of UK exports. When we look at it from a UK imports perspective, similar picture, although not as scary or as exposed. 13% of UK imports last year came from the US, 10% came from Germany, which is the second most important market again. The exposure is even bigger in the service sector. 27% of all exports go to the US, and 27% of all imports come from the US. And you can see that also by looking at the charts here. On the top, you can see the 5 UK goods exports to the US. And at the bottom, you can see the 5 UK services exports. And by looking at the figures that are attached to the different product categories, you can see the importance of the UK service sector in generally. 80% of UK GDP is services. When you combine exports and imports, you will end up with UK-US trade being worth more than 300 billion pounds last year. Very, very high figure. And the problematic fact here is, problematic from a UK perspective, is that the UK runs a large surplus. In other words, the UK sells more to the US than it buys from the US. The surplus last year, more than 70 billion British pounds, which makes the UK rather vulnerable to a trade war. Positively, as you can see from the chart here on the left-hand side, the exposure mostly lies in the service industry, and tariffs in the service industry aren't as easy as in the manufacturing sector. That doesn't mean that the UK doesn't have to fear anything. In fact, the US could implement other measures that would hurt the UK service industry, but to a certain degree, the UK is in a better position than, for example, Germany. There's also another transmission channel that the UK is exposed to, and that is FDI. The US is a very important source of FDI going into the UK. FDI, foreign direct investment, and the US accounts for around 1/3 of the UK's inward FDI. So in other words, 1/3 of all investments that were made by foreigners originate from the US. Doesn't mean that they will dry up anytime soon, but obviously if Donald Trump is successful in making the UK and the US an attractive investment place, that investment might be rerouted, which in turn is having a negative impact on the UK. So in a nutshell, the UK is very exposed to the US, maybe not as much as other European countries, but there's certainly a risk. So watching the political landscape is certainly required. Having a look at supply chain risk, that's an area where risk levels have increased as well. And we can see that in several indices. Here I've selected 2. On the left-hand side, let's start with that one, is the Global Supply Chain Pressure Index. That is a concept that was created by the US Federal Reserve, so the US Central Bank. And the higher the reading is, the more supply chain stress. And you can see massive spikes during COVID. Obviously, lockdowns were in place that caused havoc with supply chain integrity. Then things improved, went up again, deteriorated again. But over the past 6 months or so, supply chain stress has been rising again. There are bottlenecks in the Panama Canal. There are water shortages there. And there are bottlenecks in the Suez Canal. The civil war in Yemen is problematic because ships are no longer using the Red Sea and the Suez Canal. The majority of ships that are coming from Asia to Europe are now traveling across the African continent. That is taking more time, and that is also increasing costs. And we can see the increased costs by looking at the right-hand side. We can see the spot freight rates for shipping containers for 40-foot equivalent units. And the composite index has risen by 140% year on year. And there are certain routes like Shanghai to Rotterdam where that increase has actually been even higher. 241% cost increase between November 2024 and November 2023. So shipping costs have gone through the roof again, which is rather concerning given that global shipping is the backbone of global trade. Let's have a look at credit risk, which is the final chapter of our presentation. Before we do that, let me encourage you to submit your questions via the comments function on LinkedIn. so that we can address them at the end of today's presentation. But before we reach Q&A, let's have a look at credit risk. And before we actually look at B2B payments performance and insolvency stats, let's have a look at interest rates. And here on the left-hand side, you can see the interest rates that corporates in the Eurozone have to pay. That's the blue line. And I've selected France and Lithuania because they were the countries with the highest and the lowest interest rates. If I had selected the UK corresponding value, similar picture. The good news is that inflation is coming down. And because inflation is coming down, central banks have started to cut rates. We've seen that across the globe. Bank of England has done that. Federal Reserve has done that. ECB has done that. Swiss National Bank has done that. Other central banks have also done that. So key policy rates have started to fall. And encouragingly, they will continue to fall. So for example, for the Eurozone, as well as the UK, markets expect another 100 basis point cut in interest rates in 2025. So that is the good news. The bad news is, and you can see that by looking at the chart, although interest rates have started to come down, they are still fairly high by historic standards. In fact, interest rates are still pretty much on the highest level since the global financial crisis. They're much higher than 3 years ago, 5 years ago, 10 years ago. So if you are rolling over debt that is a year old, you probably face a lower interest rate bill compared with last year. But if you're rolling over a loan that you've taken out 3 years ago, 5 years ago, 10 years ago, your interest rate bill will go up despite the recent decrease in interest rates. So yeah, that is a rather problematic story from a credit risk angle. Let's have a look at business-to-business payments performance data. This is information from Dun & Bradstreet, my old employer. I've been working with that data for 15 years now or so. And again, let's start with the positives. Positive news is that in Q3, business-to-business payments performance in Europe has improved. The average payment delay in Europe stands at 11.9 days. In the previous quarter, so April to June 2024, the payment delay stood at 12.1 days. That figure is the delay beyond agreed terms. So if you had agreed on 30 days payment terms, that shows you the delay. It doesn't mean you get paid after 12 days on average. It means that you get paid 12 days after the agreed terms. There are a few bright spots, and luckily, and I assume the majority of our listeners today are UK-based. The UK is actually a country where business-to-business payments performance has improved quite considerably over the last 12 months. In Q3 last year, the average payment delay in the UK stood at 13 days. Now it stands at 11.2 days. So the UK is actually a good performer in this case. I said I've been looking at the data for 15 years, more than 15 years now, and it has always been very static, in the meaning that the Netherlands and Germany paying quick, and the southern European states, Italy, Spain, Portugal, paying slow. One country that has seen a significant deterioration over the past 3, 4, 5 years is France. 15 years ago, France was an excellent payer. Not as good as Germany or the Netherlands, but certainly better than the European average. But that has changed completely over the last 5 years. And that is also something that we are seeing in our own data at Bakering. Demand for our debt recovery services in France, they have risen a lot over the last few months. So if you are exposed to French debtors, and if you need help, please reach out to us. We are very experienced in that, as demand for our services, as I said, has grown significantly. France is a country to watch when it comes to prompt payments. Let's have a look at insolvency risk, which is my last slide before I reach the summary page. Insolvency risk remains a source of concern, and that isn't surprising. 2023 was a horrible year in terms of global insolvencies. Globally, insolvencies increased by more than 12%. At least that is what Dun & Bradstreet's Global Bankruptcy Report is saying. And that increase was spread evenly across the continents. For example, in the US, D&B data showed an increase of around 80% in business failures. India, more than 50%. Japan, more than 20%. And in Europe, the situation was equally bleak. In the UK, or in England and Wales, figure rose to 25,000. Worst reading in 30 years, I believe. Across the channel in the EU, a very similar picture. The EU has seen 170,000 insolvencies last year, and France accounted for around a third of them. Problematically, the number of business failures in the EU is still trending upwards. In Q2, we've seen an increase by more than 21% in year-on-year terms. And in Q3, we've seen another increase by around 7% year-on-year. So in the EU, continental Europe, the number of business failures is still trending upwards. In England and Wales accounts for, I think, 97, 98% of UK figures. So I say the UK. In the UK, although I only mean England and Wales, I only have data for England and Wales here, the situation is much better. In fact, in England and Wales, the number of business failures has fallen by 24% year-on-year in October. And although we obviously need more than one data point to draw a trend line, data for 2024 year to date, so for January to October, is encouraging as well. I think figures in the UK in the first 10 months of the year, they have fallen marginally, I think down by 2% or so year on year. So compared with what's happening in the EU, that is good news. What's the outlook for 2025? I'd say mixed. Mixed in the meaning that interest rates will continue to come down. That will help. Growth, at least in the UK, should accelerate on the Eurozone aggregate level as well. That should help. But then at the same time, I've shown you the overall level of interest that companies have to pay. So that is certainly a concern. Growth, although it's going up, will remain rather anemic. And then something that we haven't talked about yet, lending terms are fairly tight. So banks have tightened credit standards. Accessing credit is more expensive compared with 3 years ago, 5 years ago, and it's also more complicated. Which in turn is having a negative effect on insolvency risk. So let me sum things up. And again, if you have questions, please submit them via the comments function here on LinkedIn. Global growth in 2025 will remain weak, will not increase much from 2024 levels. In fact, the recent election of Donald Trump has certainly created additional headwinds, so I wouldn't be surprised if the IMF was actually revising growth forecasts downwards in its next global outlook. And the problem is that these downward revisions will be made from an already disappointing figure in 2024, as well as a disappointing 2023. Global growth is weak. We are in a phase where the global economy isn't doing well, which is completely at odds with stock markets, but in real terms, real GDP growth isn't looking good. When we look at it from a European level, the 3 biggest Eurozone economies, Germany is the biggest, France the second biggest, Italy is the third biggest, they will all expand by or even below 1% in 2024 and in 2025 as well. In fact, the biggest economy, Germany, has seen GDP falling last year. We'll probably see another contraction this year, and the outlook for 2025 isn't particularly good either. When we look at Asia, we quickly realize that China has its own problems. Chinese growth will moderate from 5.2% last year to 4.5% next year. And again, these are forecasts from before Trump victory time. So I'd expect that the headwinds for the Chinese economy, they have certainly increased because Donald Trump will return. And we should also keep in mind that not too long ago, the Chinese economy was growing by more than 10% in the early 2000s, by more than 7% in the 2010s. At least that's what official data showed. Official data from China was always a bit dubious, but I think there's no doubt that the Chinese economy was growing by a much more robust pace a few years ago. There are still positive news. Mainly inflation. Inflation is under control and interest rates will continue to fall. The pace of that contraction might be smaller than initially hoped for. For example, in the UK, inflation has started to increase again. Wage growth was a bit stronger as well. So I wouldn't count on too many interest rate cuts, but nonetheless, there will be interest rate cuts. One development that we haven't really talked about in this Real Talk Economics session, maybe that is something for the January edition, is government debt. Government debt levels are becoming more and more problematic. Investors are increasingly concerned, especially if the country that is ramping up that debt is governed by a minority government or has some political problems. In that light, the French government is under increasing pressure. Government debt is something that will become more visible in 2025. Credit risk, showed you the data in the UK. I wouldn't say things have started to improve, but things aren't getting worse anymore, which I think is good news. But then they're not getting worse from the 2023 levels, which were a 30-year high. And in continental Europe, insolvency figures are still rising. So all in all, that is a topic that especially credit managers, of course, will have to keep a close eye on. From a geopolitical point of view, risks have certainly increased with Donald Trump returning to the White House. It's too early to assess what that will actually mean, because in true Trump fashion, one day he says that, the other day he says something completely different. But I think it is fair to assume that there will be problems for countries that are very reliant on the US in terms of external security, in terms of trade. So I'm not saying a global trade war is imminent, but the likelihood that tariffs will be introduced has certainly gone up. And that is worrying, of course. So again, if you have questions, please submit them via the LinkedIn comments function. It would also be good to get some feedback from you. You can send that to me directly or use the comments function as well. Before I answer your questions, and I've received a few already, I want to remind you that if you need additional help, you could either connect, actually you should do both in my eyes. You should connect with Bakering here on LinkedIn. You should follow me on LinkedIn to stay up to date with the most recent developments. And I'd also invite you to navigate to the Global Outlook section on the Bakering homepage. There is an area that contains country fact sheets, a broad range of research and analysis papers ranging from macroeconomic, geopolitical risk developments to sectoral performance. And for credit managers, there's also a section where there are country-specific information about collection practices, the legal environment in the country, and all of that is free of charge. So please have a look. And if you want to give us some feedback, if you are missing a certain sector, if you want a report about a certain topic, we like to accommodate your requirements. So feel free to reach out to us. So that was my last slide. I've received a few questions. I overran as well. I thought this would take around 45 minutes. It took 55. So let me go through the question that I've received. First question: why is Germany in so much trouble? Yeah, I'm asking myself the same question, having relocated to Germany from the UK 3 years ago. I think it's a mix. It's a mix of, let's call them self-enforced errors, and global geopolitical trends. So, for example, self-enforced was phasing out coal and nuclear energy a few years ago under the current administration. That has had a negative impact on energy security, on energy prices as well. Germany has always been very reliant on Russian gas. Obviously, that is not flowing anymore. And at the same time, Germany's growth engines, car sector, chemicals, they are under threat because of the emergence of electric vehicles and China becoming a bigger player. And then I think, and I'm more and more realizing that Germany's infrastructure is aging as well. Germany introduced a debt brake in its constitution in, I think it was 2009. And since then, the German government isn't allowed to run sizable deficits. I think Germany can only run a 0.35% of GDP deficit in normal years. Of course, if there's a recession and during COVID, the government was allowed to borrow more. But generally speaking, the German government cannot run sizable deficits. And sometimes this is good, but sometimes this is bad, obviously, because the German infrastructure is increasingly aging. The country isn't well prepared for the digital revolution. There are talks about changing that now. Germany will face an early election in February, so maybe this will change. But yeah, Germany is performing poorly because of its reliance on global free trade in the car sector and in pharmaceuticals, and it was overly reliant on Russian energy. This is basically, in a nutshell, why Germany is in trouble. Second question: what's the outlook for France? Well, I'd say not much better than Germany's. Political risk in France is very high. Early elections this year ended with a hung parliament. So there are 3 blocks, all of them more or less the same size: far left, far right, and the centrists. And neither of them wants to cooperate with the other blocks, which makes policymaking rather complicated. The last prime minister survived for 3 months only. I think he was the shortest serving prime minister since the 1960s. Emmanuel Macron has nominated a new prime minister this week, but he will face exactly the same problems. Parliament cannot be dissolved until mid next year. So whoever will govern the country will have to deal with that split parliament and lack of majority. And then markets are increasingly concerned about that situation. The last prime minister, Michel Barnier, he tried to reduce the deficit and he lost the confidence vote. So he was ousted very quickly. And I can't see the next prime minister being successful in that. So next question: what are the bright spots in Europe? Are there any? Yeah, I guess there are a few countries that are looking a bit more solid than others, and the UK is actually one of them. I think the UK will benefit from a stable government for the first time in a while. The Brexit debate is over. Government has gone after businesses in its autumn budget. There will be some ramifications from that. But ultimately, I think the UK should do well, given that good demographics as well by European standards, world-class universities, fairly advanced, not a lot of exposure to the manufacturing sector, which now is an advantage. And then outside the UK, I'd say, ironically, Greece and Spain are looking good. Their confidence indicators are sound, which is a bit, I said ironic, given that during the Eurozone crisis, they were the laggards. Greece was at the brink of being kicked out of the Eurozone. But prospects for Greece are okay-ish by European standards, actually good by European standards. And similar statement about Spain, although political risk is a bit higher there. So,
I'd say there are a few bright spots in Europe, but nonetheless, Europe is facing a challenging 2025. And yeah, that's all we have time for today. I wish you a good Christmas. Hopefully 2025 will start well for you. And if you want, we meet each other again in mid-January for the first edition of our Real Talk Economic series then. In the meantime, if you have any questions, any feedback, please send it over. And yeah, Merry Christmas again. Have a good finish of 2024. Bye-bye.